Friends, thank you for being here today. What if I told you that almost every financial crash of the last century was predicted by the same single indicator? And what if I told you that this indicator is currently blazing brighter than it ever has before, even brighter than it did before the Great Depression? Have you ever wondered what it would sound like if the global financial system in all its complexity tried to scream? What form would its warning take? It would not be a cacophony of panicked voices on a trading floor, nor would it be the frantic pronouncements of television pundits. It would be something quieter, more mathematical, yet infinitely more terrifying. Right now, that system is not just whispering, it is screaming. There is a signal, an omen woven into the very fabric of our economy that has appeared with chilling regularity before almost every significant economic disaster of the past 100 years. It is a signal that flashed red before the world plunged into the Great Depression. It blinked insistently before the dot bubble evaporated trillions of dollars in imagined wealth. It sounded its alarm before the global financial crisis of 2008 brought the world's banking system to its knees. And today, that same signal is not just flashing. It is burning with an intensity that we have never seen before. This signal is called the yield curve inversion. It is at its core a simple indicator, a line on a chart representing the relationship between risk and time. Yet its simplicity belies a terrifyingly accurate predictive power. It has successfully forecasted every major recession for the last century. But this time, the inversion is not normal. It has plunged deeper, it has lasted longer, and it has stretched to a more extreme degree than anything witnessed in modern history. The message it is sending is profoundly disturbing. It suggests that what is coming may not just be an echo of 1929 or 2008. It could be, and very likely will be, far worse. The reason for this dire forecast is that this time the entire global economy, every government, every corporation, every household is built upon a foundation of more debt, more systemic risk, and more collective illusion than at any other point in human history. To truly understand why this single indicator matters, we must first decipher its language. What precisely is a yield curve inversion? Under normal, healthy economic conditions, the yield curve slopes upward. This is logical. An investor demands a higher rate of return or yield for lending their money for a longer period. Lending someone money for 10 years, for example, is inherently riskier than lending it for 3 months. The future is uncertain. Inflation could rise, the borrower could default, or other better opportunities could emerge. Therefore, the 10-year bond must pay a higher interest rate than a 3-month bill. This positive slope represents optimism and a normal perception of risk over time. An inverted yield curve is the precise unnatural opposite. It occurs when the intricate mathematics of the bond market, the collective wisdom of the most conservative investors in the world, decides that the immediate future is more dangerous than the distant future. Short-term interest rates, such as for a 6-month loan, suddenly rise above the interest rates for long-term loans like a 10-year or 30-year bond. This is fundamentally backward. It is the financial equivalent of charging someone more interest for a 1-month loan than for a 10-year mortgage. When this happens, it is the market's way of screaming that something is terribly wrong. It signifies that investors are so terrified of what is directly in front of them the next 6 to 12 months that they are desperate to lock their money away for a decade, even at a lower rate of return, just to protect it from the coming storm. This backward state is the ultimate signal of distress. It means that money is becoming dangerously tight, that the liquidity which acts as the lifeblood of the economy is drying up, and that the entire financial system is bracing for a catastrophic impact. This brings us to the anomaly of today. The yield curve inverted once again in August of 2022, and it has remained inverted ever since. This is not a mild, shallow inversion that might signal a minor slowdown. It has plunged to depths that rival and in some metrics exceed the abyssal drop seen before the cataclysms of 1929 and 2008. More importantly, it has stayed inverted for a duration that is longer than almost anyone alive has ever experienced. It has become a permanent, glaring feature of our financial landscape. This profound and persistent inversion suggests that the economic reckoning on the horizon is not a simple cyclical recession. It is a structural unwinding. It is the mathematical consequence of a global economy that has been built not on productive growth, but on an unprecedented gargantuan mountain of debt and correlated risk. The signal is clear. The foundation itself is fractured, and the scale of the current inversion warns that the collapse could be proportionate to the historic imbalances it reflects. Now, I know what you might be thinking. A line on a chart, it sounds like hyperbole, but the yield curve's reputation as a flawless predictor isn't an exaggeration. It's a matter of historical record. The only catch, the one variable that creates the psychological trap of denial, is the lag time between the signal and the crisis. When we examine these historical precedents, we see a chillingly consistent pattern, an illusion of prosperity followed by an inevitable, brutal reality. The first and most dramatic case study is the Great Depression. The 1920s were a decade of boundless optimism, a new era where technology like the automobile and the radio promised permanent prosperity. The stock market was a one-way bet, and everyday people were buying everything on credit. Yet quietly in the background, the financial system's warning light began to flash. In April of 1928, the yield curve inverted. The bond market was signaling that the debt-fueled party was on the verge of a disastrous end. But what happened? Nothing. For almost 2 full years, the market ignored the signal. This is the illusion phase. Stocks continued their euphoric climb, gaining almost 50% after the inversion. People were convinced it was different this time, but the signal was not wrong. It was merely early. By October of 1929, the dream ended. The bubble burst. The Dow Jones Industrial Average collapsed by a staggering 80%, and unemployment soared from a minor inconvenience to a national catastrophe, peaking at 24%. An entire generation was taught a lesson in financial gravity. Fast forward to the turn of the new millennium, the dot-com bubble. Once again, the world was gripped by a new era of fantasy, this time centered on the internet. Technology stocks were soaring to valuations that defied logic. The economy looked unstoppable. But in the year 2000, the yield curve flipped again. This time, the lag was shorter, lasting approximately 8 months. Unlike the long drawn-out illusion of the 1920s, and critically, unlike the situation today, the stock market began to fall immediately after the inversion. The signal in 2000 marked the end of the euphoria, not a precursor to one final manic rally. When the bubble burst, it wiped out trillions in paper wealth and dragged the economy into a recession. Then came the most recent and perhaps most relevant parallel, the 2008 global financial crisis. The fantasy of the mid-2000s was the housing market. The belief was that housing prices could only ever go up. Banks had created complex, toxic financial instruments built on mountains of subprime mortgages. In July of 2006, amid this widespread euphoria, the yield curve inverted. But just as in the 1920s, the lag was significant. For a period of 16 long months, the illusion held. The stock market continued to rally to new highs. Unemployment remained low. The economy looked strong. The Federal Reserve, completely misreading the signal, continued to raise interest rates, tightening the news. Pundits and bankers insisted it was different this time, that the risk was contained. Then in 2008, the entire global house of cards collapsed. The banking system froze. Homes were lost on an unimaginable scale, and the world fell into the worst financial chaos since the Great Depression. Finally, there is the unique case of the 1970s stagflation. During that decade, the yield curve inverted in 1973 and again in 1979. What set these episodes apart was the lag time. It was almost immediate. The moment the curve flipped, the recession began, hitting hard and fast. Stocks had no room to rally. Why was it so different? Because these were not crises born from within the financial system itself. They were crises triggered by massive external shocks. In 1973, it was the OPEC oil embargo which caused oil prices to explode. In 1979, it was a second oil crisis. These shocks hit the consumer instantly, causing spending to collapse overnight. This stands in stark contrast to today, where the crisis is not external but internal. A systemic rot of debt and leverage building pressure slowly, just as it did before 1929 and 2008. And that distinction brings us right back to the present day. The curve inverted in August of 2022, and it has been inverted for well over 2 years. Yet, just like those periods before 1929 and 2008, the surface appears deceptively calm. Stocks are rallying, driven by a new era narrative around artificial intelligence. Unemployment is near record lows. The economy on paper still appears remarkably strong. This cognitive dissonance, a screaming recession signal set against a backdrop of market euphoria, is the very definition of the illusion of calm. It is the psychological trap that always precedes the breaking point. The siren song of "it's different this time" is louder than ever. In the 1920s, the fantasy was permanent prosperity through new technology. In the mid-2000s, it was the unshakable foundation of the housing market. Today, the fantasy is that artificial intelligence will create a productivity boom so massive that it can defy the laws of economic gravity and offset the crushing weight of our global debt. Every generation, it seems, finds its own reason to ignore the signal, and every single time, reality wins. The false confidence we are witnessing right now is not a sign of strength. It is the classic symptom of a system in its final manic phase before a collapse. But this begs the most important question. If the signal is so dire, why has the recession not hit yet? What is holding the system together? The answer lies in the unprecedented events of 2020. The 1,972 seconds recessions were immediate because the oil shocks were an instant, unmitigated blow to the consumer. When a similar oil price spike occurred in 2022 following the war in Ukraine, the world braced for another 1970s-style immediate crash, but it never came. The reason it did not is that the consumer was for a brief time invincible. They were wearing a suit of pandemic armor. In response to the COVID-19 shutdowns, governments around the world injected trillions of dollars directly into the economy. In the United States alone, consumers had accumulated an astonishing surplus of over $2.5 trillion in excess savings. This massive cushion of cash acted like a system-wide anesthetic, hiding the damage that was being done underneath by inflation and rising interest rates. People kept spending, businesses kept hiring, and the economy looked invincible. Even as the yield curve screamed its warning, that armor is now gone. The anesthetic is wearing off. Those $2.5 trillion in excess savings have been spent down, evaporated by persistent inflation. To maintain their standard of living, consumers have turned to debt. Credit cards are now completely maxed out with outstanding balances hitting record highs, and the first cracks are appearing. Delinquency rates for credit cards, for auto loans are rising at the fastest pace since 2008. The invisible shield that protected the system is fading fast. When it is fully gone, the real unmitigated impact of the tightest monetary policy in decades will finally be felt. The calm is the illusion, the pressure is the reality. So which historical precedent is the most accurate template for our current situation? We can immediately rule out the 1970s. The lag time is far too long, and our crisis is not the result of a sudden external shock, but of internal systemic leverage. We can also rule out the year 2000. The market rallied after the 2022 inversion, which is the exact opposite of what happened when the dot bubble burst. We can also dismiss the 1989 inversion, which was very shallow and brief, correctly predicting the shallow recession that followed. Today's inversion is historically deep, suggesting the subsequent recession will be anything but shallow. This process of elimination leaves only two parallels, 1929 and 2006. Both of these events featured the exact same characteristics we see today. First, they both had extremely long lag times, 16 to 24 months between the initial inversion and the final crash, creating the illusion of calm. Second, during this illusion phase, both saw resilient labor markets with very low unemployment. Third, and most critically, both saw strong stock market rallies after the signal appeared, convincing the public that the danger had passed. This allowed the Federal Reserve in both cases to continue tightening monetary policy, driving the economy further toward the cliff edge. The setup is not just similar, it is nearly identical. So if we accept that the setup is nearly identical to those previous major crashes, we have to understand the severity of the event it's predicting. To do that, we must look beyond the simple fact of the inversion and analyze its character. The two most important metrics are its depth and its length. And right now, both are painting a historically bleak picture. The depth of the inversion is a powerful predictor of the severity of the recession that follows. Historical data shows an undeniable correlation. Shallow inversions, like the one in 1989, lead to mild, shallow recessions. Deep inversions, by contrast, predict severe economic downturns and sharp drops in economic activity, often measured by Manufacturing Purchasing Managers' Indexes, PMIs. Today's inversion is one of the deepest ever recorded. It rivals the extreme levels seen in the run-up to the 1929 crash and the brutal stagflation recessions of the 1970s. This depth is the bond market's way of telling us that it is not pricing in a mild slowdown. It is pricing in a catastrophic failure in the economy's productive sector. Even more alarming is the inversion's length. As of late 2024, the yield curve has been inverted for over 700 consecutive days. This is the longest, most persistent inversion since the period preceding the Great Depression. The length of the inversion is a proxy for how long the economy has been suffocating. It represents the extended period during which monetary policy has been too tight for too long, strangling businesses that need to refinance debt, crushing the housing market, and squeezing small enterprises to the breaking point. When this pressure is applied for so many hundreds of days, it does not just slow the economy down, it causes things to break. This historically long duration suggests that the cumulative damage that has been done beneath the surface is profound, and that the market drawdown required to reflect this damage will be equally severe. However, the most misunderstood part of this entire cycle is the final trigger. The recession does not typically begin when the curve is at its most inverted. The recession begins paradoxically when the curve uninverts and begins to steepen back toward positive territory. This steepening is the final fatal signal. It has been triggered before every single economic downturn. In May of 2007, the curve uninverted just a few months before the global financial crisis truly began. In November of 2000, it uninverted just before the 2001 recession hit. And in October of 1929, the yield curve uninverted at the very moment the Great Depression was unleashed. Why does this happen? This uninversion or steepening is not good news. It is not the all-clear signal. It is the sound of the starting gun. The curve steepens because the Federal Reserve is finally forced to panic and aggressively cut short-term interest rates. And the Fed only panics for one reason, because the economy is no longer just slowing down. It is actively breaking. It is the moment unemployment begins to spike, and the Fed is forced to reverse course in a desperate attempt to stop the bleeding. The uninversion is the market's way of pricing in the start of the very recession the inversion had predicted all along. This brings us to a final crucial complication, the whipsaw signal. The market can and often does provide a false all-clear signal before the real event. We saw this in 2006. The curve briefly inverted, then uninverted, causing a brief market correction, and then crucially it reinverted. This whipsaw postponed the real recession, lulling investors into a false sense of security and allowing the stock market to break out to new highs for one final euphoric blow-off top before the ultimate collapse. We also saw this in 1998. A brief inversion and uninversion scared the market only to reinvert and pave the way for the final 2 years of the dot-com mania. This whipsaw pattern is the psychological trap in its most potent form. It is highly probable that this is the very dynamic we are witnessing right now. A brief recession scare steepening followed by a reinversion that fuels one last irrational rally before the system finally gives way. To truly understand this illusion phase, we must look at the anatomy of the denial that defines it. This isn't just a failure of models, it's a failure of the human psyche driven by a powerful cognitive trap known as recency bias. The yield curve inverted over 2 years ago for investors, corporations, and consumers. The 2 years of no recession that followed feel far more real and immediate than the 2-year-old signal itself. The narrative shifts from a recession is coming to the signal must be broken. This psychological shift is what provides the fuel for the final euphoric stage of the bubble. Every new era needs its narrative. And just as the late 1990s had the internet revolution and the mid-2000s had housing never falls, we now have artificial intelligence. The AI narrative is the perfect justification for ignoring the math. It promises a productivity boom so profound that it can, in theory, allow the economy to outrun its debt problems. It creates a handful of mega winners in the stock market, which masks the profound weakness festering in the other 99% of the economy. But while Wall Street chases this AI-driven dream, the real economy, the one represented by the yield curve, is actively fracturing. The cracks are no longer subtle. We see the slow-motion collapse of the commercial real estate CR market. This is a multi-trillion-dollar time bomb. With remote work becoming permanent, billions in office building loans are coming due. Yet the buildings themselves are half-empty zombie structures worth a fraction of their loan value. This isn't a future problem. It is happening right now, and it threatens to cascade through the regional banking system, which holds the majority of that toxic debt. We also see the mirage in the labor market. While the headline unemployment number remains low, the data beneath it tells a story of profound stress. The establishment survey, which generates the headline number, has been diverging massively from the household survey, which actually asks people if they are working. The latter shows job growth that is stagnant or even negative. The perceived strength is coming almost entirely from people being forced to take on 2 or even 3 part-time jobs to make ends meet as full-time. High-paying jobs disappear. This is not strength. It is a quiet desperation. Finally, the consumer, whose pandemic armor held the economy together, has reached their breaking point. That $2.5 trillion in excess savings is gone, replaced by a record $1 trillion in credit card debt. Delinquency rates for these credit cards and for auto loans are not just rising. They are accelerating at the fastest pace since 2008. This is the sound of the armor vaporizing in real time. These are not isolated issues. They are the direct physical symptoms of the economic strangulation that the yield curve has been signaling for over 700 days. The system is no longer bending under the pressure. It is cracking. When you put all this together, the patterns are clear. The historical parallels are exact. The signal is screaming. But there is one final factor that makes this time truly unprecedented, a variable that elevates the coming crisis from just another severe recession to a potential systemic reset, the incomprehensible scale of our debt. The current situation is far more fragile than either 1929 or 2008. Back in the 1920s, household debt was minimal compared to today's levels. In 2008, the crisis was largely, though not entirely, contained within the housing market. The toxic asset was the subprime mortgage. Today, the leverage is not contained in one sector. It is everywhere. It is systemic. It is in the mortgages taken out at record high prices, in the auto loans with record high payments, in the mountains of student loan debt, in the record high credit card balances, in the ballooning corporate debt taken out at near zero interest, and most of all in the record-breaking gargantuan deficits of the government itself. The entire global system is a web of interlocking debt built on the assumption that money would remain cheap forever. The yield curve in its deeply inverted state is the signal that this assumption has failed. It is the mathematical proof that the breaking point for servicing this colossal mountain of debt is approaching. The inescapable pattern is one of strength on paper, but profound weakness underneath. While headline job numbers celebrate low unemployment, the underlying data reveals the rot. Full-time, high-paying employment is shrinking, while the growth is coming from part-time workers and people forced to take on multiple jobs just to survive. Corporate bankruptcies are rising. Consumer delinquencies are increasing. This is the classic textbook pattern that appears before every major crisis. The bond market, the smart money, sees this fundamental weakness and is pricing in severe pain. The stock market, driven by narrative and denial, is pretending not to see it. History has a clear and unambiguous verdict. There has never been a soft landing from a yield curve inversion this deep and this long, not once. To believe this time will be the first is to engage in the most dangerous form of magical thinking. What is coming is not just another cyclical recession. It is the unwinding. It is the painful, chaotic, and necessary structural reset of a global economy that has been built on years of excess leverage and false confidence. The longer this illusion of strength lasts, the more pressure builds in the system, and the more violent the eventual release will be. This analysis is not a call for fear. It is a call for awareness. The yield curve doesn't tell us to panic. It tells us to prepare. It is the economy's most reliable truth teller, whispering the truth long before anyone else wants to hear it. It is saying that something fundamental is broken, that the pressure has reached its limit, and that pretending otherwise will not change the inevitable outcome. In every storm, the period of calm right before the thunder cracks is the most deceptive. And when the storm hits, people will claim they never saw it coming, even though the signal was right there flashing red for all to see. This time we can see it. We can feel it. The yield curve does not lie.